Let me open the panel session. Again, the topic is application of machine learning on the AI in banking on the capital markets. And with one subsidiary question is, does it bring value compared to traditional approaches? So the panelists in the order of intervention, we have Loïc Brient. Loïc is with the Chief Data Scientist, Data and AI at BPCE, one of the major retail banks in France. And the topic that Loïc will be addressing is AI and financial security, in particular detection of fraud in real time, AML as anti-money laundering, which is a very important regulatory issue. And Loïc will be followed by Marie Brière, Marie, right here, who is the head of investor intelligence and academic partnerships at Amundi Investment Institute. She's also a professor at Paris Dauphine PSL University and ULB, Université Libre de Bruxelles. And Marie's topic is robo-advisors and more generally the use of AI in portfolio management. Our third speaker, panelist, is Natacha Baumann. Natacha is head of data strategy and deputy CDO, chief data officer at BNP Paribas Personal Finance. And Natacha will be speaking about the use of AI in credit scoring for retail customers. And Natacha will be also addressing some of the limitation of the use of ML in credit scoring, which is explainability. And we'll talk a lot about explainability. That is the understanding of the process for getting from inputs to output results, which is a very, sometimes very opaque, especially for complex model like neural networks. And model explainability is very important for different reasons. First, users must have confidence in the models that they are using, and consumers have the right to know why a loan was refused to them. And another issue to address is in consumer lending is the exhibition of biases, race bias, gender, neighborhood of residence. These are very important issues to address when you deal with machine learning in retail banking. And last but not least, Christophe Pérignon. Christophe, here, is a professor or dean of research at HEC Paris. And Christophe will expand on the need for explainability of ML models on algorithm, especially the credit space, with both credit scoring and also regulatory capital attribution. And Christophe will also address the issue of the trade-off between performance and interpretability, performance being associated with complex and opaque models, and interpretability with simplicity. So we start with Loïc. Each panelist has 5 minutes to make his case, and then we will open the question Q&A with the floor. So Loïc, your turn.
Thank you, Michel. So let's talk about AI and financial security. Of course, everybody think about real-time detection when we talk about financial security and AI. But in fact, before talking about real-time detection, I think that the basis is using machine learning and AI to analyze us, to analyze fraud, to help analysts understand the new schemes of fraud, the new schemes of of money laundering, the new schemes of financials, terrorism, finance, and that that way of using machine learning and AI is very useful because analysts have their experience, but the same way that was presented before, the machine learning help taking into account a lot of more information, more diverse information, taking into account text, taking into account non-structured data, and with graph learning, taking into account link between different entities, individuals, corporates, places, and so on. So the role of machine learning in analysis is very important. Then when you have analyzed, when you have restituted those analyses to analysts, to non-quantitative analysts, you can go to real-time detection. But do you use AI for real-time detection, or do you use AI to build real-time detection tools? Through knowledge distillation, through other tools like that, you can use AI to build very powerful model, very with very performant models, and because those models are complex, they are not always efficient, computationally speaking. They are not always efficient for analysts who have to react to those model outputs. And so, through knowledge distillation, through simplification of models, you benefit from the machine learning performance, but with more computable and more understandable models. And so, machine learning is a powerful tool for real-time detection, but it's not always the tool that is operationally used. Finally, I cannot speak about AI without speaking about Gen AI, and talking about Gen AI with respect to financial security. First, it could be, but it could be, and it's not something that is done for now. It could be a wonderful tool to help analysts writing reports and gaining time to see more files and to have more structured reports. But we also see some evidence that the last generation of LLMs could be very powerful to analyze a large quantity of data and to, in an extent, detect some fraud scheme. Unfortunately, LLMs are probabilistic models, but are not built to such detection action. So we have to go beyond those evidences and to make some real research about those abilities for which we have only some sparse evidence for now.
you, Loïc. And we'll leave the questions for at the end, right? So now we move to Marie Brière, who's going to talk about robo-advisors and the use of AI in portfolio management.
Okay, thank you very much, Michel. So yes, I'm going to talk more generally. Maybe I can go. All right, the use of AI for capital markets, and in particular the applications we can make in asset management. So of course I couldn't resist the pleasure to ask ChatGPT to do it for me. So ask him what will be the impact of AI on finance. And what's interesting is that there are two main fields. There is a list of 10. I'm not going to detail the 10 main implications that ChatGPT sees of AI on finance, but there are two very important fields that are related to what we're doing in asset management. The first is the construction of quantitative investment strategies. So here you have data and predictive analysis, algorithmic trading, quant analysis, and portfolio management. And the second one, which is also related to the asset management business, is clients' relationships. So customer service and customization is one potential important impact. And also you mentioned it, Michel, robo-advising. So I will cover these two topics and try to see what we can do, give you some concrete examples of what we do, and also discuss, does it bring value or not, basically. So first topic, AI and quantitative investment. What can you do? I think we discussed that extensively with Thierry Foucault before. You can incorporate alternative data, so new types of unstructured data sets, into your investment strategy. So basically transform unstructured data into quantitative data that then you can use to build an investment strategy. And there is a wide variety of what you can use. So apart from satellite imagery that we discussed just before, you can use text, you can use sound, and there is a variety of sources from regulatory filings of companies, but it can be also social media, blogs, podcasts, so a lot of information you can exploit. Then you need to do that to use different types of techniques, so web scraping to extract the information, NLP, machine learning, computer vision, and all that. A few concrete examples. What can you do with textual analysis? Typically what we do in finance and in asset management, we build sentiment measures. So we build that on a variety of things. So here I quote some example on the climate. So there are a couple of academics, but practitioners do that as well, measuring climate sentiment. So how much do we talk about the climate in the news, for example, and see if it has some forecastability for financial markets. We have a paper doing that and showing that, yes, there is predictability that you can find from climate sentiment on stock returns, for example, and that it forecasts the outperformance of green stocks, for example. But you can do sentiment on various things, including individual sentiment at the firm level, for example. So it's something which is done very widely. Satellite imagery, I mean, Thierry spent some time on that. He mentioned a lot what we can do with short-term signals. So, for example, what you can measure parking lots information and do kind of nowcasting, so forecasting the real-time prediction of the variable. But you can do also a lot for sustainability measures. And you can use, for example, this satellite imagery to measure carbon emissions, or analyze the impact of companies on their ecosystem. You can measure deforestation, you can measure gas flaring, so a lot of, I would say, ESG signals that you can measure from that. And later this afternoon we'll have a session on greenwashing. It's also a very good way to verify what the firms are concretely doing. So you can verify if what they are claiming in their annual reports, for example, corresponds to what they are doing in practice. Does it bring value? So that's a tricky question. I mean, I mentioned some good examples that, for example, sentiment has some predictive power. So there are some proofs that it can bring value, and you can derive interesting signals to build investment strategies. The big challenge is the challenge of market efficiency, that the information advantage disappears through time. It's something we measured. We have a paper on that showing that, I mean, there is a variety of new types of signal you can measure based on newspaper articles. You can very finely measure the type of news, the trends, the horizon, the coverage of the news. It's all great, but if you look at how this information is incorporated into prices, it's almost immediately incorporated. So there is very little you can derive to build a proper investment strategy. So I could give other examples. We have also a paper on stock return forecast based on machine learning techniques. And here again, we show that these techniques are great, but their capacity to forecast depends a lot on market conditions. And there is a lot of instability in the quality of these predictions. And then we use, for example, we propose a new method to aggregate them in order to get a better forecasting accuracy. So does it bring value in finance? I guess the results are mixed. The second topic is customers' relation. So you can improve your customers' relation, your clients' relation, the clients buying your funds through these new tools. One very concrete application is robo-advising, even if we do not see so much AI so far on robo-advising platforms, but you can use that, for example, to do client segmentation and profiling, and that's something we will talk more about credit analysis. So you can also improve your chatbots, and something I like a lot, which I find quite interesting, is you can also do behavioral coaching. So you can analyze the trading behavior of your clients and measure, and that's a very famous example by Schwab, for example, if they're becoming nervous, if they start being stressed on financial markets and are very likely to sell because they are stressed. And here, and it's a very good example of human-robot interactions, then the salesperson, the human, calls the client and tells him, it seems that you're going to be stressed, maybe it's time to talk and reinsure the client. So these are the kind of things you can do with AI by basically analyzing the trading data of your clients. Does it bring value? I believe yes, at least what I've been studying with Milo Bianchi, my coauthor, on robo-advising, and we have a couple of papers on the implications of robo-advising, is quite positive. People are more attentive to their savings, they invest more in equities, they rebalance, something they would never do if they were not advised by a robot, because we have a tendency to sleep on our asset allocation when it's considering our personal finance. It can also promote financial inclusion, so people that are less financially educated see a higher benefit of these kind of tools. But there are big issues with trust and explainability. A lot of clients don't want to use the services of robo-advisors simply because they do not trust an algorithm. There are a couple of changes that maybe we can discuss later. AI can be a black box. There are issues of explainability, and Christophe will touch on that more largely. There is a risk of manipulation as well. I think this is something very important to discuss. And last and not least, the financial and environmental costs are very important. It was mentioned quite a lot with ChatGPT training, which has been costing about 500 flights London-New York, for example. So that's something that will need to be discussed, but let me stop here in the interest of time.
Now, Natacha, on retail banking and credit scoring for retail banking.
Yeah. Thank you. Hello to everyone. Just a first disclaimer, I'm probably the only non-data scientist or non-statistician on stage, so just to manage expectations after, if you have any specific questions, I will not have slides on equations or algorithm, but I will touch more on the business side. So just one thing, I don't know if, sorry. All of you know about personal finance in BNP Paribas? Yes, no? No? So BNP Paribas Personal Finance is a credit specialist. We have about 20 million clients, so you can see that we have a lot of customer interactions, about 100 billion of outstanding. So that makes a lot of credit scoring. So machine learning is something we start to use, not only for credit scores, but for many use cases. So Marie mentioned some of them, and Loïc as well. So I will specifically speak about credit scoring because it's really the heart of our business, as you understood. So a score simply has one interest, is to predict default. So is to see if whether a customer will be repaying the debt or not. We have different type of scores. It could be machine learning, simple linear regression. It could be internal score, external scores. In personal finance, we have running more than 300 scores. So it's a very core expertise at our side. And of course, we looked at machine learning to improve their scores. Improving a score for us, it's not only about risk, optimizing risk, it's obviously to make more NBI, so to give as many credits as we can, and it's also to save OPEX, because it's automatizing some processes. I know it's after lunch, so you might be a bit of digesting, so I will ask you to participate a little bit. How many of you have ever taken up or asked for a credit, a loan, whatever, mortgage, whatever, in the room? How many of you? Okay, that's a few. No loan, no credit. Oh, there must be some rich people around. How many of you know why they had a yes or a no? Are they bankers? Not many. So machine learning has come into question for us, of course, because of increase in performance. So we measure that with Gini. I will not explain this because you know probably a lot more than me around that. The other important point was to use more data. We mentioned just before alternative data. So this is one thing. And we are benchmarking for many years what the machine learning scores bring towards compared to linear regression models. And there's a significant increase usually and a significant uplift in performance. What we've seen also is alternative data sometimes, and it's good for everyone, allows us also to take new profiles of people that we have sometimes rejected before because they had a bit strange profiles, or we had not enough information. France is a good example for that because we don't have a positive credit bureau, whereas in other countries we have positive credit bureaus, so a lot of information. In France we have less information, and with the open banking data, I think maybe Christophe you'll mention it later, we have a lot more data now. So thanks to PSD2, if you heard about that, we are able to score new clients that we were not able to score before. So this brings some inclusion or financial inclusion perspective that is really good. Having said that, when we use machine learning, there's some implication and things we need to look into. So Michel, you mentioned that, which is explicability, sorry. And Christophe, you'll come back on that, so I will not speak too much about it, but probably I'll speak about the regulation, because if you've been through a credit score, it's always good as a customer to understand why you've been said yes or no, and sometimes you have no idea why. So regulator is about the same. They ask us to be able to document why we said yes or no, or at least it should be auditable. So if we have models that are very sophisticated, you mentioned deep learning, that becomes a bit more difficult, but maybe in the future it will be easier to look at that. We have also some rules in some countries, affordability rules, so that we need to really obey the certain regulations. And of course, there is the fairness question, where we should look at the biases that the models bring, and also see if we are not more excluding people than including people for several reasons. So explicability is one thing, but this is only one piece. The other thing we need to take into account is stability, robustness of the models, and this comes also from the data we use. The more data we use, the more risks you have that the model are not stable in time. You know that, and even though we are a very big bank, it's common that sometimes we have data quality issues or data sourcing issues. So data has to be stable and of quality over time and accessible, of course. So the more variables or data we use, the more difficult it becomes then to have a robust and fair model over time, and stable model over time. And just to mention also transparency and acceptability. We have obviously different machine learning models by product or by country, because what is acceptable maybe in France is maybe not acceptable somewhere else. It's rather the opposite. You might be able to use traffic fines in China. I don't think French people would accept that the traffic fines, if they pay it or not, would be included in their score model in France. So we have to look at that. So there's not one score that can fit all, and we have to be aware of the evolution of mentalities around. So maybe the younger population in the audience would accept to use, I don't know, their social media data. Maybe the oldest population would say, no way, never. So we have to be aware of that. And one thing I'm not sure we will cover today, but one thing is industrialization of the models. What we see with our IT counterparts is that building a score or building a machine learning, very interesting, a very sophisticated score, is usually 30% of the work. 70% remains putting into practice and making it live into production. So I mentioned POCs. Of course, we have thousands and thousands of POCs. What's important is to put it into production, and that's 70% of the work. And that's also very important to understand for data scientists, because we can have very clever models if it's not possible to put them into production because of various reasons, and data availability and data flows is one. I mean, the interest is very limited. I will just finish on something is about talent, because you mentioned it. So we need to be very much concentrated also on having the right talents, but also having people that can understand both the business and the scientific part of it to make the link. So upskilling, reskilling is one of our issues. To finish, I think it's all a question of return on investment. Choosing an ML model versus a traditional model is also being able to take all the points that I mentioned into one piece, which is what is the return on the investment. If my models brings 5% uplift, it might be not enough with all the constraints I mentioned. So we have to take all this into account. I didn't mention here carbon or GHG emissions that are produced by these models. So I think at some point that would be a challenge to have the right return on investment of those models, and I'm happy to discuss about that with you if some of you have found the right ways to overcome this challenge.
Thank you, Natacha. I think we have a challenge with time, you know, but we'll deal with it. So take your time to discuss, you know, explainability, among other things.
Thank you, Michel. Good afternoon, everyone. I would like to use my 5 minutes to talk about some of the opportunities and the challenges created by the use of AI in credit markets, especially like explainable AI, the XAI that you see on that slide. Okay, so the main task for AI in this field is to forecast the probability of default of individual loans, the PDs. So the typical application so what we do here is we consider various models, more or less complex models, and then we want to pick the best one. The best one is in terms of typically predictive performance. You pick the performance metric you like the most, AUC or mean square error, etc. And then you sort the models and you pick the one with the highest performance metric. Okay? So here we have logistic, a decision tree, a support vector machine learning, random forest, XGBoost, and artificial neural networks is the one with the highest performance metric. So that's the one we're going to use. So we test this performance using brand new data that the model has never seen, the test data. The model was not trained on this data, so it's very a fair comparison, a fair horse race. Okay? So the typical application we consider in our research and also in the banks, as mentioned by Natacha, are the screening activity of loan applications. So there is a flow of new loans which needs to be assessed, and some of them will be accepted, others will be rejected. It's very popular. All the banks, all the fintech are using this type of technology. It's super important because the decision of the algorithm is going to potentially change the life of people. We talk about accessing the financial resources that they require to buy a house, to launch a new business, or to finance their higher education. So this is very important. That's why it's heavily regulated. It's part of the AI Act in Europe. It has been classified as a high risk application for which we may require systematically human oversight. Okay, human in the loop, which kind of challenge a little bit the scalability advantage of AI, by the way. A second application we typically work on in our research is to set regulatory capital for banks. So here it's a stock of existing loans sitting on the balance sheet of banks, and we need to assess the risk of those loans in order to set the requirement in terms of capital for banks. It's brand new. There is a lot of discussion, a lot of proof of concept or challenger model, but it's typically not in production yet. It's super important. We talk about financial stability of financial health of banks. We talk about a potential source of systemic risk, and it's also regulated within the Basel Accord or by various European directives. Okay? What is common to these two applications is the need for explainability. We need to explain why BNP Paribas Personal Finance rejected this particular application for this particular individual. And also, if we want to rely on this technology to set the regulatory capital of banks, we need to understand what's going on, what are the main drivers of those models. Okay, so again, now, because we need to take about both into account the performance, predictive performance like in the past, but we have a second dimension that we need to care about, which is explainability in my context here. So we go from a one-dimensional problem to a two-dimensional problem. So now we will have to pick the model we like the most, but we have to take into account at least two dimensions. So it's, I have to say that it's even more than that. It's not a two-dimensional problem, it's a k-dimensional problem, because besides explainability, we may also care, as mentioned by Natacha, about the fairness of the decision of the model, or the frugality or lack of frugality of the model. We talk about consumption of electricity or CO2 emission. Also, we need to take into account the data privacy concern associated with some models. Okay, so but let me go back just to the two-dimensional problem, because it's already challenging enough. We see that there is a trade-off between predictive performance explainability, which means that we need to give up a little bit of transparency / explainability in order to boost the performance of our model. So here we're gonna have to rely on some Pareto frontier, and then depending on your preferences, you will pick the model you like the most. So we see we have two families of model. The so-called natively interpretable models, like the logistic regression or decision tree. You understand what's going on. You understand why the decision is making this forecast. And then we have the less transparent, but the less transparent models that we see on the bottom right corner, for which you need, in a second step, an explainer. One of these tools, which all the data scientists are using systematically, the SHAP, the LIME, that maybe you heard of or played with, and they will explain what are the main drivers within these complex models. So another terminology that we keep hearing about are the so-called white box models, transparent, and the black box model, as you can tell from the name, in which you don't understand what's going on. Okay? Typically, there is some kind of a general consensus to say that the white box models are low performance. So hence the trade-off I was referring to before. And the black box, they deliver a higher performance, better performance. So what we find interesting is to work on a new generation of models, a third family of models, the so-called new generation of white box models. So they are completely transparent, yet they deliver a high performance. So there is a lot of research going on both in computer science and also in people like us, making those kind of bridges between computer science and business, in particular finance in our case, to kind of get the best of both worlds, which is both transparency / interpretability, explainability, and high performance. So if you want to know more about that, there is a lot of research, as I said, in computer science with Radley at Duke, so that's computer science. Here also with Christophe, who is in the audience with us, we recently wrote a white paper, which is an opinion et débat published at Institut Louis Bachelier, which you can get a lot of information. And also outside academia, in the industry, there is like pioneers. Some banks like Wells Fargo, they are super ahead of most of their competitors in order to use models for which you will get kind of, by definition, a transparency level which is great here. So they are natively interpretable or natively explainable. Okay. So here, I guess this new family of models we are working on collectively, it's the way to go. We were talking about the future of AI, at least in business application, in finance. That's the way to go in order to get both performance and explainability. Thank you very much.
Thank you. Now we have only a few minutes for questions from the audience. Yeah.
Good morning. I have three questions. One for Loïc Brient, second question for Natacha Baumann, and third question for Marie Brière. How do you improve data quality, establish process for rigorous data collection, appropriate store management, as well as quality control to detect and correct errors? Okay, second question.
Maybe you can take a round of questions.
We have only a few minutes for questions.
So if you can take
Just one question. Yeah.
Thank you all for your brilliant presentation. I have only one question to Natacha, which deals with ethical matters. Do you limit your data collection on ethical concerns? In particular, do you have access to Sécurité Sociale database, which I presume would be very helpful for you, in particular if the given person is a regular client of a psychiatrist? Do you have limits on this issue? Are you forbidden to collect data from Sécurité Sociale? And if you are forbidden, what happens if you still do? For example, hiring a hacker in Kazakhstan who would collect the data on Sécurité Sociale for you.
I have a complementary question to you, Natacha. So we see a lot of research, maybe I read that in your paper, Christophe, about using social media data or cell phone data, for example, to measure networks, etc. Is this something that is allowed in Europe? And do banks do that right now? So I'd like to have your view on that.
Yeah. So, for the data itself, which one we use, I think, I will mention for Europe, right, in France in particular, we have a kind of conduct. And anyway, the EBA gives a lot of guidelines of not using some sensible variables, sensitive variables. So anyway, even if you wanted to use them, these kinds of data, we're not allowed to use them. We have a very clear regulation on that. Regulators names, we don't. We have a huge fine. I think we just close the business down. The risk is that we would have a huge fine, so at least 5% of our profits, and then I think we will be out of business very, very quickly.
Not of profits, of turnover.
Of total, yeah, total income. Yeah. And yeah, I think, and on top of that, usually we have, anyway, we don't collect those type of data. And to come back on Marie's question about the social media, that's not used into the scores. We have other use cases, like marketing use cases, where it could make sense. And with the GDPR, usually we ask permission. So we would never use your data, browsing, whatever, or cookies, whatever, without consent. And that would be more on marketing targeting, which is very different than from the scores. And for example, recently we also put a strong list of sensitive data, like for example age, skin color, for example, that is not is forbidden. But some countries, I just want to mention that, are more open into that. For example, I'm working with South Africa, where you give your color, the skin color, for other purposes which is non-bias, because otherwise you can't prove that, on the contrary, you're inclusive, because you don't have the information. So it's both sides. Some of the data on both sides could be looked as a European as very intrusive, but in other countries could look as useful because it proves that you don't discriminate. So it's a question of discriminate. Sometimes it's interesting to see what's going on beyond our borders.
Yes, concerning data quality, at first, in banking and insurance, data quality is good. With respect to other industry, our data quality is good. Not as good as we wish, not as good as supervisors want that quality to be, but it's quite good. Then AIs can help us to enhance data quality through detecting it, through proposing better data quality, through collecting data to enhance data quality. And finally, concerning data quality and AI, lack of data is an information. When you lack data about a client, it's an information. It's a way to know that the client has not provided the data, and it's an information. So lack of data or lack of data quality could be an information and could be used as an information in input of models.
Question on this side of the audience.
Hello, thank you for your presentations. So I have a question about, so in the same dimension of what it is asked, it's about the sensitive features, sensitive data. So so we know that, for example, this year we have the European AI Act that is coming to Europe, and there are now many machine learning models that are put into production. So I would like to know if there are some incentive to maybe revise the previous models put into production, or they are already taken into account in the sensitive features dimension.
Yeah, just a short answer on that. So we will revise the models. Anyway, we have model checks normally every other 2 or 3 years, but here we have the complete review of the models. We have a model risk management platform, because we had to put this type of tools into force, and we will add the new AI Act specifications into this new into this platform, so that we can monitor the models. And true, we need to spend some money on that. That's why I mentioned the ROI at the end of the day, because this is something we didn't necessarily do before, and AI Act will bring some more specific things. But I think it's also good in terms of putting everyone on the same page, and the bank and fintech on the same regulations. It's not too bad for us in the end.
And a model is not a project. You don't build a model, and that's all. A model is a product. So you build it, and you monitor it. You make some correction, and eventually you decide to stop its run, and to give a chance to another model, or because it's no longer in use. So a model is a product, and you have to monitor it, and it's it's have a life cycle.
So if I may, no, but that's a very important question. So it's not really about removing some of the variables which now become illegal. It's when AI Act is challenging the banks on the, let's say, fairness decisions, whether the models is discriminating against women. The gender is not part of the model already. So what the regulators want them to check systematically is the fairness of their decisions. So they need some extra layers of verification, some statistical tests systematically checking whether the likelihood of getting a positive answer from the bank remains the same for men and women. When we condition for all the other factors associated with creditworthiness, which is income, all the socioeconomic variables that we know very well. So it's not removing something, it's adding some more verifications.
Just a last question, I'm sorry, in the interest of time. We're going to start the new session probably in 3:50. What time is it now?
Late already?
Yeah. So the last question. All right, so let's I'm sorry. At least 2 or 3 people in the back. Quickly.
Okay, so firstly, thank you guys so much for your presentation. I just have a question for Professor Pérignon. I hope I'm pronouncing that correctly. How do you plan on bridging that gap between performance and explainability?
I'm sorry, can you repeat?
How do you plan on bridging the gap between performance and explainability?
So I guess it's just, we need to account for both. Because historically we were disregarding the explainability part and say, okay, this is just a horse race, we want the fastest horse and we want to use this one. So now it becomes, as I said in my presentation, a two-dimensional dimension. So we try to maximize in both dimensions, and then we'll have to make a decision. There is some kind of exchange rate or marginal rate of substitution between the explainability dimension and the performance dimension. So that's why I'm so optimistic about this new family of models, because by design, they will be natively interpretable. And then we just have to maximize the performance dimension then, within this family of models.
Very quick.
Thank you very much indeed. I'm wondering, we are coming out of a period of exceptionally low interest rates with very low loss ratios. How do you benchmark models? Okay, so this is about fundamentals. The other question, I'm a macroeconomist by training. The other question is, why do we need machine learning on credit scoring? Really, beyond the fashion and the need to appear relevant, what are we achieving? I'm not against it. I would like to understand what we are achieving.
Very, very quickly, because we are out of time, so we really need to stop. So it's a great question. How do we benchmark models? So we have a paper on that instability of the forecast, and it's true that it depends on economic conditions, so you're completely right. So, but that's not only the problem of machine learning models. It's a problem in finance, that there are regime shifts, and I mean, this forecastability can change depending on economic conditions, and maybe you need to introduce new variables, and that's something that strategists know very well, right? So that's a big question. Would you like to add one word, but very, very quick, because we are...
Not just a short answer to the second question about why do we need ML and AI. It's a very good question. A little bit provocative question, but a very good one. The simple models like logistic, they are doing great. So the way we usually put it is that these new machine learning models, they will allow us to account for much bigger data sets. They will allow for non-linear relationship, interaction of variables. But when we hear the banks, sometimes they say, but we are not using this huge database. We're not using data from social media, etc. So I think it's a very good question. We need to ask this question instead of systematically just estimating those complex black box models. Let's think some more. That's a good question.
Thank you very much. And I'd like you to thank the panelists for their intervention. Thank you.